Hi there, everybody. This is Alex Fensky. I'm the lead agent for the Chicago Southland Homes team here at Keller Williams Elite, and I am excited to bring you the May market update. This is going to be probably about 15 minutes or so. So if you're ready for it now, buckle in. Otherwise, you can watch later. I will be watching the chat as I'm talking here. So if anyone is on live with me, I'll keep an eye out for those questions. Otherwise, I'll circle back and answer them later. Um, there's a lot of interesting stuff going on in the market. And we've been saying for a long time that things can't go on this way. They can't continue forever. We've seen some of the changes happen already, yet it may not be what you think. So please reserve judgment. Let me go through the nerd stuff, and I'll tell you what everyone sees coming and what's happening right now. Um, First off, let's talk about the number of new listings, the number of people that are listing a home for sale throughout northeastern Illinois. That number was down in April by nearly 20% compared to April of last year. So, for every 100 homes that came on the market as new listings in April 2021, only 80 came on the market this April 2022. So that's a pretty significant drop. And even if you look from the beginning of January until now, year to date, we're at 14% below. So for several months now, there have been fewer people listing homes for sale. And that actually wasn't really the case for most of the last couple of years, and certainly not by 20%. Now, on the flip side, when we look at the number of pending contracts, that's the number of sales contracts that are pending at the end of the month, waiting to close. Those are actually down by almost 15% compared to last year, which again falls right in that same category as the number of new listings that were down. So what we're saying is that the number of people that listed a home for sale and the number of buyers that wrote a contract both went down by a similar margin. Um, and there's something that we believe contributes a lot to that. It's called the lock-in effect. The lock-in effect is something that happens anytime mortgage rates go up. They have, and I'm going to touch on those in more detail in a couple of minutes. But if you're a homeowner, you've been thinking about moving, and maybe you don't have to move, but you've been considering it, and you have a 2.5% interest rate on your current mortgage, and then now you're going to go and buy another home. Maybe you're gonna buy a larger home for maybe your family's grown, and you're going to sell a home for $300,000 and buy one for 500. But you're going to have to not just go up in price. You're also going to look at a mortgage rate that's going to be over 5%. And so you're going for 2.5 to a 5% mortgage, and the difference in price and mortgage rate, meaning the overall price, a difference in affordability, becomes so wide that a higher number of people will say, "No, we're not going to move. Maybe we'll put an addition on the current home, or we'll finish some unfinished space, or we'll deal with it." Whatever the case may be, this reduces the percentage of people that move. So it lowers the overall housing turnover rate. And that's called the lock-in effect, and that's something that's definitely happening now because rates have come up a lot very quickly. Um, the next metric I want to touch on is inventory, which we can also call the number of homes for sale. So the number of homes for sale, if you followed on the last market update, it's been going down every single month, which is weird because it's supposed to be going up this time of year. Our seasonal norms say inventory should have been increasing since January, and instead it's been decreasing. Well, it appears to have bottomed out. It appears that it actually came up by a few hundred homes. It was about 2.4%. So it's not a big increase at all. In fact it's not even noticeable really. But it did not go down again. So it kind of flattened out. And if we look at some of the other things, it'll probably start to come up a little bit more. But that was the first monthly increase in inventory since July of last year. So from June to July of 2021 was the last time that the number of available homes actually went up. That's a long stretch. Now, with that said, the number of available homes in April was still down by almost 32% compared to last April. So we got a long, long, long way to go before we get back to anything in the realm of normal. Because even last April, inventory was low. So you're going to have to go back several years, and we're down. Honestly, we're closer to about a third of normal inventory levels right now. So it's going to take a long time to get back to that, it's going to take more people listing their homes, and that's not something we're seeing. Um, Next up is supply. So supply is we measure it in months. So we see how many months of supply are out there. I'll give you an example. If there's 600 homes on the market and there's 600 that buyers are buying every month, 600 on the market, 600 selling every month, that means it would take 1 month for the buyers to buy up all the homes for sale. That's 1 month of supply. A balanced market is when there's 6 months worth of supply, which in that example means 600 people buying every month. You would need 3,600 homes available for the market to be considered balanced, for pricing to be flat, for there to not be lots of friction in crazy situations in real estate transactions. So that's what supply is. And we're currently standing at 1.2 months of supply. It's a record low, and it's been in that realm, 1.2, 1.3 for several months. It's not budging yet, and as I mentioned, it'll take a lot to get that back to a balanced market. So housing supply has remained flat. But as I mentioned, the number of transactions went down. So here's what I want you to picture. Let's say that's 600 on the market, 600 buying. Let's say that's the current scenario, and it's not far off. Now picture another market where there's only 300 homes available and 300 are selling every month. Well, it's still 1 month of supply, but there's only half as many transactions happening. Now I'm using an exaggerated number, but that's kind of what's happening in the marketplace right now. The relationship between the number of sellers and the number of buyers hasn't changed. It's still the same months of supply, but there's fewer of both of them. So there just aren't as many transactions happening. So that might explain, if you've been in the market, a little bit of what you've been feeling. It just means the market has thinned a bit. It's not as liquid. There's not as high of turnover. But the relationship between sellers and buyers has not changed. Pricing. New stuff happening in pricing. Median sale price, seasonally adjusted, is up 9.6% from last year. That's a pretty strong number. It does appear to be that the rate of increase is slowing. And as of April, we have surpassed pricing from June 2021, which was previously record high. So what that means is we set another record high in housing prices in northeastern Illinois. We're at the highest they've ever been. If you think about buying, I'm going to encourage you, though, to look ahead and not backwards, because you can't buy in the past. You can only buy in the present or the future. So it doesn't do as much good to look backwards and say, oh my gosh, I missed the boat. The only question is what's going to happen in the future. And I'm going to go into that here. Fannie Mae, which is a government-sponsored entity that's basically the largest mortgage buyer in the country, released a new report recently in light of a lot of the recent changes to federal monetary policy and the mortgage markets. And what they did is they said that they expect home price appreciation to make a rapid plunge back to single digits, coming off of a record high 19.8% during the first quarter of this year, meaning first quarter of this year, home prices were going up by nearly 20%, which is absurd. Down to 6.5% by the first quarter of next year, still going to take a while, and 3.2% by the end of next year. I want to make a major point right here, though. You notice they did not say prices were going to, at any point in the next couple of years, go down. They said they're going to come off of their record high appreciation and go back over the next 2 years to what we would consider normal appreciation. So take that one, and I hope that's one of the takeaways that you get from this. Nobody is projecting prices to actually fall. They're just going to slow down how fast they're increasing. Kind of on a similar point, Fannie Mae is also projecting that the number of homes being sold will drop by about 4.1% this year. They've recently increased that projection, or I don't know if you want to say decreased, to where they're expecting actually a 7.4% drop in home sales this year. So when we say home sales, which means the number of homes that are being sold, and we actually just talked about that, right? Where the number of listings drop, the number of contracts drop, and it's the same nature of the market, but there's just fewer deals happening. That's what they mean by that. And so that's no surprise. Um, Here's what I'll point out though is home sales in 2021 were up by 16.6% compared to 2020, which was itself a strong year, up 6.7% over 2019. So you're looking at well over 20% increase in home sales over the last 2 years. So when we drop back another seven, it's actually not a major issue. It's not a correction or anything like that. Let alone a crash. I mean, we're not talking about anything like that. What we're talking about is a slow and gradual return to normal over the course of the next year to 2 years. Um, Mortgage rates, I mentioned, I would go into some numbers on that. Mortgage rates have gone up quite a lot in a short period of time. 3.11% was the average mortgage rate for a 30-year fixed rate loan at the beginning of the year. As of today, May 5th, that's 5.27%. It's over 2 points higher just in the course here of 4 months. And that obviously has put a big dent in affordability for buyers that are looking on top of record home price appreciation. That's tough. It's the highest the 30-year fixed rate mortgage has been since August of 2009. Been 13 years. But I'll point out a couple things. Number one, when you think back to the housing boom of the early 2000s, rates at that point were averaging around 6%. So rates in this range historically are actually pretty low, and they do not mean in and of themselves that there is any kind of that the housing can't be strong, that it's going to be a weak housing market. It doesn't mean that at all. It just has implications for how much you can afford. Lastly, on that, Federal Reserve just had their most recent meeting earlier this week, and they're taking more actions to continue tamping down inflation, which is raging out of control right now. It's even higher than it was a month ago when we had this conversation. And they're going to be beginning selling the assets that they were buying the last couple of years, which is actually going to suck some money out of the mortgage-backed securities market and continue that upward pressure on mortgage rates. So we do expect those to continue going up. On the overall economy, what Fannie Mae is saying is that I'm going to read this quote from the article. While a soft landing for the economy is possible, which is where inflation subsides without an economic recession, historically, such an outcome is an exception, not the norm. What that means is that we got inflation raging. The Federal Reserve is going to be aggressively raising their overnight borrowing rate, which doesn't directly impact you as the consumer, but it affects the financial markets. They just raised it by a half point. They usually only change it by a quarter point at a time, so they made a fairly large increase there earlier this week in an effort to slow down inflation. And what this quote is saying is that historically, when they do that, it does cause a recession. If there was a way for them to do that without causing a recession, they'd love to. That's called a soft landing. But they don't have control over that, and they can't let inflation keep going at over 8%. It causes too many problems. So they've got to do it, and this is going to be like hey, this is going to hurt. It's going to hurt more now, but in the long term, this is what it's needed. And so what that means, and there's other indicators that within the next 18 months or so there will be a recession. Now understand, that is not saying that you're going to see anything like the Great Recession. That's the recession that's most recently in most of our memories, excluding COVID, which is really a strange thing. But please don't. When I say recession, I don't mean like an 2008 recession, and nor does any other entity or organization that makes these projections. It just means that overall economic output will go back a little bit instead of forward. That's all. So the Fed is their actions are likely to cause a bit of a recession within the next 18 months or so. But that doesn't actually mean anything direct for the housing market. So take that with a grain of salt. All right, I've thrown a ton of information at you, and I'm coming up on my 15 minutes here. So here's the takeaways. Number one, anyone thinking of buying a home, it is still true that homes will be more expensive tomorrow than they are today. Period. The prices are going to be higher. The rates are going to be higher. So if you're on the fence or you're considering it, or you're thinking about asking yourself the question, should I wait purely for financial purposes? The answer would be no. It's going to cost you more tomorrow than it is today. Um, I will also point out that in environments like this, with rates going up, adjustable rate mortgages can be attractive, depending on how long you intend to stay in the home you're buying, or what else you expect to be happening financially for you. There are adjustable rate products that you can save like a full point on the mortgage rate, meaning instead of a 5.25, you get a 4.25 for an adjustable rate mortgage that would be fixed for the first 5 years. It's called a 5-1 ARM. They also have 3 and 7 year, and actually some lenders offer a 10-year adjustable rate product. The longer out that initial fixed rate period goes, the less the benefit is between that product versus a 30-year fixed. So a 3-year ARM would save you even more, but that's a pretty short window. So you might want to look at an adjustable rate mortgage, depending on how long you're living in the home that you're looking at buying now. And then lastly, for sellers, as I mentioned before, the market has thinned, but the balance has not changed. It's still very, very, very much a seller's market. So if you have property that you're considering selling, especially if you have what I call extra or unused property, maybe you inherited it, maybe it's a rental property, and you've been thinking about getting out of the rental business, or anything like that. If you have additional property, it's a fantastic time to sell it because you can sell and you don't have to buy. Because buying is, as I mentioned, it is still a challenge right now. I think that's it. So I don't see any questions right now. So I will put a bow on this. Please do reach out for questions. You can call us at the office, 708-808-0220. That's 708-808-0220. Or you can drop me an email, alex@chicagosouthlandhomes.com. I'll be happy to answer any questions that you have for you, especially if you have property to list, because we got buyers that are looking. There's not much out there. So if you're thinking about selling, give us a call, give us an email. We'll be happy to talk with you and give you some good advice. Thank you very much. Hope to hear from you soon.